Hello and a warm Collisions YYC. Welcome to my returning guest this morning, Mr. Jeremy McCrea. How you doing, Jeremy?
I'm great. You?
I am fabulous. I always enjoy these conversations, and we've had a bit of a pre-chat on the world of energy investing. And we've landed on what I think is a fabulous theme for today of how to be, in quotes, how to be a better energy investor. And no one better to talk to than you. You've been on the show before. You've given some perspectives. Some have come true, some have not. We'll touch base on that a little bit. But your current role, you are managing director equity research at BMO Capital Markets. And you just said you've been in this place for a year, but you've been in this sector since what, 04, 05, like a couple lifetimes?
20 years here. And 20 years in energy is a long time.
Oh, well, yeah, we could do a whole other episode of kind of what you've seen when from wet behind the ears, Jeremy, to like, I've seen this play out before, maybe.
Yeah.
Well, I want to be clear with the audience. We're recording this on February 27th. I'm only saying that because the world changes and the world shifts. And this is going to come out probably in a couple of weeks. We'll be mid-March. There'll maybe be some different information around tariffs, maybe our relationship with our what sometimes is our best neighbor, sometimes not, to the south of us, may have shifted. How much is that? Let's start right there. How much is the unknown variables that are now the US-Canadian relations? How's that affecting your world, or is that a microcosm versus the bigger picture?
No, that is the entire world right now here. 9 out of 10
Okay.
conversations with institutional investors, the majority of the people that we talk to, that is all the questions. What's going to happen with the Trump tariffs? Are there going to be tariffs? What are the rates? When do they get implemented? What are the reciprocal tariffs that we are going to have? And all these questions dominate the conversation. Unfortunately, I don't think anybody really knows, though. And I think that's the uncertainty that really drives a lot of the natural buying and selling here. You basically put a stop to all the natural buyers that would come into the market here today, just given this type of uncertainty that we have right now.
And is that what we're seeing? Just a wait and see.
It's a wait and see. And the part of the issue too is it seems like it changes every single day, and you just don't know. Did he say something in this press conference? Did he say something on Truth Social? Did he say something in this conversation here? And just trying to keep track of what's going on. And you see that in the market here, where suddenly everything's up 1-2%, and then it's back down 1-2% here. And it's just trying to play catch up here, just over the last month and a half here, really, for the most part.
It is a roller coaster, and we all know business does not like, or business or investment does not like, a lack of security or lack of any. And certainty is an interesting concept, anyways, when it comes to investing. And the joke is how good is your crystal ball? But the layer of instability and the lack of sense of where things are going right now. I'm even finding it in some of our clients, and they're like, yeah, we really want to go forward, but we're kind of just going to, like, you're not wrong to wait and see right now. And that really slows things down from a momentum perspective.
You're already seeing it, and just the uncertainty. There's being in Calgary here, you have a lot of friends that are working on different M&A projects and that, and they said it's pencils down just until we get some clarity here. And the issue, though, that it was supposed to be March or back in February, and then that got pushed out to March, and then there was indications that it was going to get pushed out to April, and then that got reversed. And I think everyone's just saying, until we actually get some certainty, we can't make major investment decisions until we know, should we focus on oil? Should we focus on gas? Should we focus on more US properties? Should we just pay down debt? And just that uncertainty just is already transpiring here now. And it's just this, we're in this void here of a lot of different investors saying, I can't come into the market here right now until we get a better sense of clarity, and the valuations just haven't reflected the potential worst case scenario here quite yet. And so that's where this uncertainty here is leading to right now.
Is not really knowing what the impact will be. In your role, and obviously working with a large organization like BMO Capital Markets, how much, I'm assuming there's modeling going on, there's scenario planning, there's, again, it is still crystal ball because we don't know. How much of your day-to-day now is like, playing the what if game, or are you kind of sitting back waiting to get something concrete? But I can only imagine there's lots of scenario planning going on.
I think I put the tariffs in another category of things you can't control here. And so you don't know where oil prices are going to go. I don't even think the King of Saudi Arabia knows where oil prices are going to go a week from now, let alone a year from now. And so we put the tariffs in that same category here. It's just, these are things that you can't control and you don't know. And it's, if you want to be an energy investor, you just have to accept that fact that there is things that are outside your control. So how do you become a better energy investor? It's almost you're gonna have the commodity move up and down. You're gonna have new regulations come in and out here, and those will always be somewhat of a black swan event. But as long as you hold ideally some of the better companies here who have not a lot of leverage, where you can make it through different business cycles here is almost the most important thing here for the long term investors. And more short term though, one of the biggest things that we always look for is where's that rate of change? Who's doing something different that, despite all the noise here, is not recognized by the market here? So who's finding a new oil pool, a new way to drill wells or complete wells, that are going to improve the long-term outlook here over the next 5 years. So when we look back 5 years from now, and you could point and say, you know what, when they started and finding this new discovery, this new oil pool discovery, that was going to change the go forward growth projections or the go forward profitability. And that's what really matters at the end of the day here, because the oil prices, if you look back, besides the Russian war, oil prices just generally kind of move to that long-term supply cost, and sometimes they're above, sometimes they're below, but long term they always kind of revert back to that mean. And as long as you're finding the company who's doing something different that hasn't been appreciated by the market, generally that's where your best performing stocks are going to be nearly all the time. So,
I appreciate that.
even stepping back one more step, you can have high quality companies, but they're not necessarily the best stocks, and vice versa. You could have maybe not the highest quality companies, but if they're changing and improving, those can actually still be good stocks. So it really depends on the market here, outside of the tariffs and the oil commodity prices.
And for yourself, and I think you've said this, I'm harkening back to a past conversation I've had, you and I've had, episode 1 or episode 2. They blur together a little bit around getting some of those calls from global institutional investors asking you for a little bit more, like, what's the exact formula? What's my exact rate of return? Like, how is this exactly going to play out? But what I just heard you say was, well, that is part of investing in this space or in this class, is there is a little bit of volatility. And I like what you said, we don't know what the price is tomorrow, let alone a year from now. How, back to being a better energy investor, if I'm comfortable and I've been in the space for a while, I've gotten used to that and I've accepted it and I've learned how to ride it. Are you getting those phone calls from organizations that are maybe net new to the sector, and you really, have to index on that education cycle?
Yeah, so if I would say one of the biggest things that's changed over the last decade, let's just say, is the amount of energy investors versus more generalists. And the issue that we've seen just as a general trend here is more uh, portfolio managers cover different sectors. So instead of 10 years ago, you would have had a dedicated energy portfolio manager. Now that portfolio manager does energy and mining and other resources like lumber or
Mm,
something.
okay.
And so you don't have the sophistication that you once necessarily did. And the issue that you have in energy here is it can be a technical business when you start to go down into the weeds of things here. And so what you're finding here now is smaller companies that individual wells matter more. You're not seeing the attention paid on those type of companies, and you're seeing a lot of that capital flow to larger cap names. You combine that with
I see.
the shift in more ETF interest as well too. So this is, instead of a mutual fund, it's buying, like an exchange traded fund, and those funds are based on algorithms that just generally buy the largest companies in the sector here as well too. So that's where you've seen a bit of valuation divergence here as a long-term trend as well too, where it's just a focus on larger, more liquid names. And I always kind of joke about this here too. Like I always thought the number one goal of a portfolio manager was to to make the best returns. But what it's come down to is just I think that the number one goal that they're having is keep my job, and then returns is
Mitigate the most risk. Yeah,
yeah.
absolutely.
And so mitigate risk here, and you mitigate risk by not taking outside risk, and that's where unfortunately the energy, it does have a lot of volatility with the commodity. And so if you can avoid that risk with being in low leverage names, more liquid names, and just names that
Yeah.
have more diverse portfolio in terms of assets, those are generally the names that are kind of keeping the long term attention here.
And is that having impact on some of the smaller players that, to your point, might have an outsized valuation from a technology or innovation or an upside opportunity perspective, but they don't have that brand recognition and some of those standard metrics that the algorithms are going to look at to go, oh, this company is a safe bet. it can give us but that level of expertise it takes to know who's doing what on the street or who's doing what up in Northern Alberta, that feels like that could lead very much to kind of undervaluations of those players.
And that's what's happened here for sure. Like
Okay.
you will look at the, you can look at devaluation in a number of different ways here, but use more of a standard one, the free cash flow yield for some of these smaller companies, they're sitting around 15-20%. And is that ultimately going to transpire? Maybe, just depending on the commodity here again. But the interest in these junior names are not being nearly as on the radar screens with the broader institutional investors as they once were. And to be fair, there's a long history of poor performing oil and gas stocks here over the last 20 years. I would say we have learned our lessons, though, post COVID and, the
Okay.
Russian war, with the driving higher commodity prices did, ultimately improve the balance sheets for a lot of these companies. But now that commodity prices have come back down to more long-term supply costs here, especially what we see in the US, we're looking at the business here saying now are these real businesses? Are they not? And for the most part,
Hmm.
a lot of these companies have just said, we can't rely on having higher commodity prices to make things work. So, does our business work at the current commodity price? And a lot of those companies who struggled, they have merged with other companies. And for the most part, though, this is a different business than it was even 5 years ago, let alone even 10 years ago.
Yeah.
Debt's lower, the profitability is quicker to when you get payback on your wells, and it really is just a better business overall here.
How's that affecting the junior, that consolidation, which we've talked about I was listening to one of our past episodes yesterday, just in terms of, being at a certain level to be able to play on the global stage. And, there was a lot of consolidation happening to get there. Are you still seeing that? Like, what's obviously we're in Western Canada. I'm in Calgary. You're also in Calgary. The junior oil and gas play has been a huge backbone to our economy, to wealth creation. And it's also changed significantly. Where is it now, even where it was 5 years ago? And how do you see that continuing to change based on kind of what you just shared?
Yeah, so I was looking at a few stats here as well too, and if you go back from say 2010, we've seen about a 70% drop in the number of publicly listed companies here in the oil and gas business. So you've definitely seen some M&A, and actually even Q4 of 2024 was one of the biggest M&A periods here in terms of dollar values of different mergers and acquisitions. So it's real and it's happening, and there really is a business case to be, if you want access to LNG and get LNG access through the Gulf Coast, you almost need to be investment grade to
Yeah,
get those long
you
term.
shared that in the past. That's one of the quotes I heard when I was re-listening to, and I assume that was only continuing to be the trend. Mhm.
Yes, and it still continues to be. You get better, service agreements here in terms of your drilling costs, your completion costs, and just access to different sizes of capital here. You can get investment grade debt versus high yield debt. So all these things start to matter, and ultimately that's why a lot of these CEOs are saying, you know what, it probably actually makes sense for us to probably get together here now at this point.
Mhm.
So that's encouraging. And then even if you look at the most recent employment stats coming from, from the government websites and that, um, employment in oil and gas is back up to 2014 levels here.
Oh,
And it
interesting.
just shows
I hadn't heard that. Interesting.
it feels good. Like the sector really is back in different ways, but it feels good. The unemployment rate is sub 3% here. It's come up just a little bit in the last as oil prices have come down, but for the most part, all throughout the last couple of years, we've been sitting between 2 to 3% here. So this business really is come back, and when you see the capital discipline for a lot of these companies, it goes back to the whole bigger theme. These are real businesses, and we just don't need to rely on higher commodity prices here to make things to make things work.
Well, that's interesting to say. Like we're back to the same level of kind of activity, especially looking at from a labor force and an employment perspective, and to also have the same stat that it's been a 70% drop since 2010. Well, 2014 is only a few years, and 2014 was the start of kind of that. We'll just call it the dark times between, like, I don't know, 14 to 19 ish. It felt like that 6 months downturn that just wouldn't go away. But to hear that it's back to that same level, but it just seems to have such a different level. Like the vibration or the RPM doesn't seem seem to be as high as it was in those boom times before. Back to your point about the model has changed.
Yeah, and I think that's I, I don't know if it's just the media attention. We went through that period, post COVID here, where a lot of the focus was on energy transition. And do we really need oil and gas here? Going long term into the future. And then I think just with the energy security that came with the whole Russian and Ukraine war,
Hmm.
it really kind of changed perspectives here. And it wasn't so much an energy transition that we were going to see; it was more energy security, and maybe it's more of an energy addition that we're going to see with all these renewables. But more importantly, oil and gas is going to stick around here, and how do we adopt to a changing environment here with oil and gas? We still see different funds that are have laws and rules internally that aren't allowed to invest in oil and gas. So there are still different funds that are not participating in some of the momentum that we've seen with oil and gas here. So there's still probably more momentum here to come. I always think back to this, going back to the tobacco industry back in the late '90s, and so this is when you couldn't, back
Hmm.
when you're investing, you didn't want to talk about tobacco because it became clear that the health risks for tobacco were bad, and the tobacco industry was down 75% from. I'm getting these numbers wrong, the dates wrong a little bit, but from 1995 to 2000,
It
but
was
from
it was decimated in that period of time,
it was
essentially,
decimated.
from an investment sector for sure. Mhm.
But from 2000 to 2010, it was one of the best performing names in the S&P 500 because
Interesting.
it was
You don't see those headlines though,
you
Jeremy.
don't see those headlines, and it just it came to a reality that yes, smoking was declining in North America, but overseas it was still continuing to grow globally here, and the amount of you know it was an attractive sector from an investment point of view because of the free cash flow that this industry was producing. And it reminds me somewhat like oil and gas here. Yes, there are risks, there's regulatory risks. We are going to transition away from oil and gas at some point here, but it's become a bit more of a reality. It's not going to actually probably happen in the first 5 years here. It's probably going to happen in a much longer time frame than anyone's investment horizon truly is here. And so that's where we've seen a slow and steady, interest come back into oil and gas here, bit by bit, despite what we see sometimes in these mainline media headlines.
Yeah, well, fair. Yeah, so be aware. Be aware what you read on social media. Uh, Talk to me about getting access to this. Like back to being a better investor. You talked about the individuals, the companies you want to focus on that maybe are not your big easy. I'm just going to use the word safe a little bit ubiquitously here. The safe plays because they're large and they're recognizable and they have brand awareness and they have strong balance sheets, those types of things. But I heard you loud and clear where the real opportunities sit are the individuals that are either from a technology perspective, know-how, innovation, maybe all of the above, are able to perform at a higher level. How does the average investor, and again, maybe I have to define investor, the individual investor versus someone who's investing on behalf of a large portfolio, how do they get access to that information? Because oftentimes you got to be pretty close to you got to be close to the drill bit to know what's going on, right?
Yeah, and I would say that it is. You can still be a generalist investor and still do well in energy here. There's just probably just a few simple rules that you want to kind of keep along with
Okay.
here. Um, you want to make sure you have a good balance sheet here, as far most because the volatility in the commodity will continue, and that is
Mhm.
almost the one certainty that we can take away from this is oil is going to move higher and it's also going to move lower here, and you just got to make sure you can make it through that next cycle here, whether it be oil or natural gas. So that's kind of the first thing first.
Okay.
Um, the second thing though is what is your economics that you get for drilling a new well, and so what we always kind of talk about, and these are some general rules of thumb, it's not so much you reach the payout of your well. When do you reach two times payout? And this is one of the issues that came out of, I want to say, the US basins in particularly here, was everyone was getting quick payouts. That was a lot different than where you were,
Mhm.
10, 15 years ago. And so most wells in North America will reach payout within 12 months here. It's what that well is producing post payout is what really matters here. And that's one of the things that is not really present in almost any company presentation here. It's starting to happen a little bit more, especially for Canadian operators, because in US shale plays, you will bring on a well at 1,000 barrels, and by the time it reaches payout, it's only doing 50 barrels. And so by the time you reach that 2 times payout, you're talking about another 10 to 15 years here. Where in Canada, where
Interesting.
we've had
Okay.
so much regulation, we haven't seen the growth out of the Canadian plays that we've seen in the US. And so we still have a lot more inventory to drill. But when you look at some of this inventory that's still classified as what tier one, we get the same payout like a lot of the US plays, but it's more the when do you see that 2 times payout? And top quartile would be 2 times payout within 2 years, average would be 5 years, and your fourth quartile would be into that 10-year time frame. And that's really where Canada shines relative to the US plays here, is just that ability to recycle capital much quicker. And if it wasn't for pipeline issues, we would be able to grow much quicker just because those returns are much higher. What we've done instead of those returns is increase, dividends and buybacks and debt repayment. But now that debt really has fallen quite a bit, we're kind of in this emerging new era here of
Hmm.
where to really go. You've seen some of the larger names move up in terms of their valuation, but you haven't seen that capital flow into the smaller names in part of the TSX comp. So I'm talking about your billion to a few $1 billion companies. And once those names start to move up more, then I think investors will start to say, okay, if I miss those, now I got to go into the smaller cap names. But right now, that Goldilocks region here is really those names that they're part of the TSX comp, but still haven't got that full recognition of being a larger ETF of a or that the ETFs would kind of come into here.
So yeah, you're kind of catching that sweet spot. But what I'm really hearing is like they've really beefed up and improved their balance sheets over the last few years. But now you've got this more positive economic realities of the 2 times payout. I've never heard that explained that way. So which kind of creates a sweet spot of a potential upside and some opportunity. Like what I'm pulling out of that is that pending all these other black swans or whoever flies into the scene, there is some real opportunity to see some upside in the few years ahead.
Yeah, like and for sure, like some of the best plays here are generally the Clearwater plays, and the one thing that's made the Clearwater and the Manville play a lot of is this new drilling designs that we have here. So most investors would be familiar with your Montney here, the Permian, the Eagle Ford in the U.S. Uh, what the fastest growing play here in Canada is now the Clearwater and the Greater Manville play, and what's really changed here is you don't actually need to frack these plays here, these oil plays. What you're doing is drilling a well, and it kind of splits off into a pitchfork design once you get to into your formation, and just the ability to drill those wells and how much oil comes out when you do that drill design really has made the Clearwater and the Manville the fastest growing plays here in Alberta. And that's where a lot of smaller companies actually benefit because, for the most part, to drill these wells, you're only talking about $1.5 million to $2 million versus a typical Montney well that's upward between $8 to $10 million. So, as a junior operator, you can drill more of these wells and get that statistical type curve, and not risk the individual wells sometimes here that come with these bigger drill programs.
Interesting. Really coming back to consistent innovation and how in the technology side of how we do it, how we extract. You get access to maybe a reserve that was known, but the new drilling technology allows it to be that much more effective from an output side of things.
Yeah, and so when you look at that and say, is this recognized by the market? Is this not? Uh, it's starting to be a little bit more recognized here now that we've seen the growth and how much more inventory and how this growth can likely continue here, as opposed to trying to focus on what's going to happen in the Middle East here with oil prices. Is this going to change? Is oil going to go up to $80, $90? What are these geopolitical events? Sometimes they come and they go. And it's sometimes, are you buying into something that's already somewhat being priced into the commodity market here already?
Yeah.
And that's
Yeah.
where,
Yeah.
the whipsawing back and forth can uh, just cause angst, I guess, is what a lot of different investors is the best way to maybe put it.
I think angst is a good way. It's a good way to put it. Before I got on our call this morning, I was like, oh, you know, uh, energy price predictions the next 5 years. It was a roller coaster of information that I found, and I walked away going, I feel less informed than I did before querying that search into Google.
It's great. Like you look at say, I'm just going to take some of the bigger prognosis, like the EIA, the IEA, these are the OPEC. Everyone always puts out decade-long outlooks here, and if you look at, for the most part, every forecast in terms of when we were going to roll over for oil demand has been wrong. We've always
Yep.
exceeded
Every
it
time. Every
every
time.
single time here, going back to the last, we pull decades for the last 15 years here, because we keep track of what's the long-term trend that these organizations see, because these organizations have access to a lot more government officials and data than almost any other investment bank dealer out there. And when they continually miss the mark here as well too, it just shows that this energy transition isn't really transitioning. We're not transitioning. It's, the demand continues to go higher and higher, and surprise. And I think that's where there's becoming a little bit more recognition that should actually help to come with the long-term commodity here.
It's going to stay around for longer. Okay, well, I think we got number one. We got number two. What's I'm sitting here with my pencil, and hopefully the listeners are as well. What's number three?
In terms of what to look for here,
Yes. Yeah. Yeah.
number one, balance sheets. Number two, your economics here, and number three, you got to find something that's off the radar screen here with
Mhm.
investors if you really want the big upside here. This is where you find every single year there's names that are up 50, 60%, and it's like, how did this name go up so
When
much
you
here?
say big upside, is that what you're talking about? Like a completely outsized, like not even in the stratosphere of the regular market?
That's right, and so so these are where you're trying to find those home runs, and they really do start from a valuation that is not appreciated by the market. And typically, what these names is they are um, adopting some technology from a larger operator and implementing it on their land, and that's what's really making
Oh,
the
okay.
big
Okay.
upside here. I'm going to take this two different ways here for the last point. That's one way to find the big outside gains, but there's nothing wrong with hitting singles here in the energy market, and where you have the um, you can kind of move up and down here with the volatility in the markets here. There's nothing wrong with making 10% and every single year, because ultimately that does grow here. And when you look at the dividend yields typically in this market, you're sitting at around 5 to 8%. Companies are still buying back shares between 2 to 5%. They're still growing at 5%. Like, there is a lot of um, reasons why a shareholder, if they can have a longer time frame, will ultimately look back here 5 years from now and say, you know what, that actually did kind of just continue to compound over and over and over again, despite
Mhm.
all the volatility that we saw in the sector.
Well, looking for picking those unicorns, or picking put it all on red. Like that's that. I appreciate you talking about that as an opportunity, but if you're looking at an overall healthy portfolio, you're going to consistently get that 5 to 8%. You get a dividend. Like, there's a lot of benefits to playing longer. And I'm assuming some of the larger global, maybe institutionalized players that you talk to, are they chasing, or are they, maybe chasing is the wrong word? Are they looking for those outsized returns, or are they looking for more reliable, dependable, predictable, trustworthy returns, or a bit of both?
It's a bit of both, but it's a bit
Okay.
of a barbell approach here. Some are
Okay.
saying, okay, I got my stable group of energy names, but I need maybe just that one name that could really
Okay.
surprise to the upside here. Who could, and that's where you're really trying to focus on who's adopting new technology in a company that where the perception is not really there, or the eyeballs have kind of somewhat ignored it or looked over it, or don't fully appreciate how this new technology may actually change the overall 5 year projection here. And so that's what you're
Okay.
really trying to look at, is who has inventory that's not being appreciated by the market here. And ultimately, when they start showing that, and those wells start showing up in the financials, that's when you see more long-term investors come in. The other thing that we like to tend to do that I don't think is maybe being fully appreciated is, what is the flow of funds and flow of capital coming into this? That is looking at here is who's buying and who's selling energy stocks. And if you actually go back and look at the last quarter here, when tariff threats start to come on, for the most part, we actually didn't see all that much selling here of the Canadian sector. We can kind of track about $40 billion worth of investments from these funds, and about almost all the selling came from international global funds, just on concerns of what these tariffs may mean for
Okay.
Canadian operators. But in reverse, though, we actually saw more U.S. funds pretty much buy all the selling from the international global funds. So you had U.S. funds buying, whereas international funds were selling here, which kind of creates this interesting dichotomy of where these U.S. funds were saying, you know what, the reality is maybe we're not going to have the tariffs as big or as long, or this is just
Hmm.
clearly a negotiating tactic here. So it's interesting to see where where the flow of funds is shifting here.
That is interesting. I wouldn't. Yeah, I love those little tidbits. Like, huh, things that make you raise an eyebrow. Raise an eyebrow. Talking back, and I really want to kind of talk about this a little bit. Thinking about your role, and how to be a better energy investor. Very clearly, is getting access to information that maybe the market hasn't factored in. How does that end up on your desk? Are you out there? Are you out in the field driving around in your truck, seeing who's doing what? Sorry, I doubt that's the case. I'm thinking about where you get that steady flow of like trustworthy, reliable, but also consistent information so that you as a team, you as the lead, but also BMO Capital Markets feels that the information that you're now sharing and maybe some of the recommendations you're looking to make are well informed or as well informed as possible.
It is a very good question here, and that's why I think research analysts exist here is because we concentrate on one sector only,
Mm.
and you ultimately get to know all the stakeholders who are involved. So it's not just the executives of a company, because for the most part, everyone in the conference calls will have that same information. Where you're trying to find is information that's not necessarily with those executives. So you're talking to reserve evaluators, you're talking to you go on field tours here, and you typically tend to talk to different drilling managers here, and you can get different body language in terms of what they think is important, what's being missed, where they see new opportunity. You're talking to different suppliers here. You have a lot of, by living in Calgary, naturally, you have a lot of friends who work in this sector here as well too. So it's a lot of these conversations, and it's not so much if you hear one data point that makes it true, but you have a data point to go I want to say almost like horse trade here, where that's an interesting piece of information. Let's see if we can collaborate that with another
Yeah,
source that we
let's see if
have.
we can break it or validate it a little bit, right?
That's right. And so ultimately, it comes into the mosaic theory here, where you get a whole bunch of little pieces of information that are all trending toward one final conclusion. And you don't necessarily have that conclusion, but a lot of pieces of information all suggest that that's the way that things are leading to. And so I'll go back to, um, best practice here. If something works for one company, it's probably going to work for another company. And so
Right.
if one company if a drilling manager is seeing success with a new drill design, I'm just going to say new drill design bit, that bit can probably be used for another company here. And you can be like, okay, the market probably doesn't recognize that this new other company is going to be using that here probably within a few months, but that's going to change their go forward profitability.
Mhm.
And so that's where you can kind of use and get a leading edge here in terms of where the ball is going here.
And back to your point about it's a small world in Western Canada, but all of these individuals and all these companies, they're all interconnected. They've all worked for each other. They've all worked together. There is so much overlap in terms of the ability for that technology to kind of move itself through the sector fairly efficiently that maybe wouldn't be known by the outside right away.
Yeah, and it's interesting how social media has changed that, because
Hmm.
we're back on social media on LinkedIn here. Jeremy McCrea, CFA, just got to put that in.
Yeah,
And
absolutely.
yeah, but there's a lot of other good social media content out there here that you don't necessarily need to be in Calgary to hear what's really going on. Like you get a lot of um, trends and smart geologists and engineers posting things that are working for their company here, and ultimately it's a new way to actually get information that's completely different from where we were, even I want to say a few years ago, in terms of the expertise that's now on social media.
Outside of LinkedIn, do you have any other does anyone get their energy sector information off TikTok? I'm just picking around. There's so many
Yeah.
platforms I could. Is there any other places like where, back to being a better energy investor, where would you recommend somebody spends a little bit of time just if they just want to learn and kind of be exposed to, like you said, energy from information from different sources?
So so it's usually X, Twitter, and
Okay.
LinkedIn are typically where you see the more technical operators on. But a lot of these companies here now too, between investment funds, even the reserve evaluators, they always publish free reports here in terms of what they're thinking of, how they're seeing new trends emerge here as well too. So there's a lot of information out there that really is available, and just in terms of understanding where those new directional changes are being made here. Yeah, it's hard to say, kind of say them all here right now,
For
but
sure. No, no, X LinkedIn. I would have picked
yeah.
LinkedIn as an easy one, but I was curious more about the ones that might not have. X kind of makes sense. I was more curious if there's any ones that maybe wouldn't be the first ones to pop to mind. LinkedIn seems so obvious. Anything business, go to LinkedIn first. It becomes your almost second search engine when it comes to, business related. And people are putting out such, like, including you guys, you're putting out such great information. Like, you can drown yourself in articles and white papers, and it can be a bit overwhelming as well.
It's just it's unfortunate. Well, unfortunate. I'm not quite sure which is the way to look at it, because there is a lot of good time, real time information here that's very it's punchy, and that's what I think a lot of the way we absorb information here
Mhm.
now is
Yeah,
give me
it is.
something punchy. We don't have time to read a 30-page document about why LNG in Canada is important. Just, when's LNG coming? When is LNG Canada coming online here? So that's just different pieces of information, and it's interesting where LNG Canada, they have a lot of their information comes up on their LinkedIn page here. And so that's where you get the information. It's not in your traditional news or media source here. So it's just um, different ways where people get information here now too.
I appreciate your comment. What is a news source anymore? It's wherever you choose to get your information. Then it's up to you to kind of understand how much can I trust this? Who's benefiting from me believing this information? Like, you got to have a bit of a critical thought process. But that's another podcast for another day.
Yeah.
Hey, curiosity. This is a bit of a random question. This is all of a sudden Jeremy becomes my de facto expert because we're on the line. Um, Obviously, friction with our neighbor to the south has caused us, and I've certainly saw some media rhetoric about it that I took as a positive. What if we look at interprovincial? What if we look at pipelines? What if we look at doing better business with ourselves? Is that really something that would shift or have a fundamental, an outsized impact on the energy sector? Or is it one of those things, Canada, we're kind of a price taker, not a price setter, to oversimplify that statement. But if, you think as you put your hat on about, oh, okay, these tariffs come in, maybe we get some friction with selling to the South, and then we open up and get a little bit better to dealing with each other interprovincially. Does that have any real impact, or is that maybe just a response to a negative over here? Maybe that helps soften the blow a little bit. Any perspective on where that might land in terms of impact on the industry?
It's the only thing. I'm going to take it one step further here. Immediate, probably not. Like, there'll be different reciprocal tariffs that relate to sand and chemicals going back and forth,
Mm,
because
yeah.
for the it will have an impact, and it's just too hard to know right now in terms of where the exemptions are going to be, and what exactly the tariffs are going to be. But there's one thing that's united this all is just the reality that, what, maybe we do need some additional pipelines here in this country. At least it's opened up the conversation here as a start, and that's where it's good to be here, where it's not. You can actually have those conversations here in terms of what pipeline do we need in Energy East? Do we need to, look at this additional leg to TMX here? So it started those conversations, and that is probably one of the most important things here, because ultimately new investors are going to look at this and say, you know what? Maybe Canada isn't going to be as landlocked as we had always once thought here. I would say a few years ago, I would have said we will never build another pipeline here in this country. I'm not quite so sure here. I'm not going to say we will, but at least
Yeah, it's not as binary as it was not that many years ago. Probably even when you and I first chatted, it felt like the ability to do a large capital like project on a national scale felt like that ship had sailed.
yes, and ultimately what that will do though is it will bring in new investors saying, you know what, maybe you guys aren't as landlocked here. Maybe you will actually
Mm,
have more LNG facilities come on stream. Maybe it's not we don't like the fear mongering and the it just changes the way investors think about Canadian energy, and ultimately that should probably help valuations here. Ultimately, if you do see a new LNG facility proposed or new pipeline proposed, we're talking another 5 years by the time
yeah,
that's
yeah,
likely
yeah.
in operation, which is past the current U.S. government likely mandate here in terms of
Mhm.
different politics, politics change all the time here, right? So it's um,
The projects, I love it. We're talking about March 4th, which is like, X amount of days, it's, 6, 8 days away, while also talking about things that really fundamentally change who we are as a nation are 5 years plus away. Like, it's really skews what is the 140 character news cycle versus what it takes to create long-term change.
Yes, and so ultimately, though, but it is encouraging there that there is a recognition that energy transition is not going to happen nearly as quickly, and maybe we do need to think about getting some of these projects up and running here because it truly is helps the overall Canadian GDP, and if that is one thing that I think a lot of investors are looking at here, energy and major energy projects are like a real way to help boost that here.
And I appreciate because you're a lot of times the people you're talking to, or when your phone rings, this is from an international audience, right? It's not local or even south of the border. It's people it's globally that want a perspective on the opportunity in this part of the world, right?
Yeah, Europe has a number of energy investors that look at Canada here, and and a key reason why is because we do have good ESG type of scores. We're there's some very big environmental thresholds that every energy operator lives by here, and they're not. It's a cost of doing business here in Canada, but ultimately
Yeah.
you should get a better cost of capital because of that. And so you do see investors, but if this opens up here a little bit more in terms of our exportability, it should ultimately bring in more capital into the country here.
hmm I'm glad you brought up ESG. I'm not hearing it nearly as much in conversation as I was even 6 months ago. Is it just become table stakes and how we operate? For a while, it felt like it was this flag that was getting flown. But my wife works in the energy sector, and it's also just kind of part of their day to day how they do business.
Back in, I want to say like early, like almost pre-COVID here, there was a lot of funds that were raising money on high ESG standards, and a lot of
Mhm.
those funds raised a lot of money, and those are the funds that were performing well. So it was, what's your ESG? If you wanted to get some of this
Yeah,
money
yeah.
that's flowing into ESG, what's your ESG scorecard? So a lot of companies were highlighting it, putting in the first pages of their presentation here. But as capital's moved out of those funds, um, for different reasons, it's not as important as it once was here for a lot of
Okay.
these companies. It's still important. I don't want to dismiss it, but it's not the first slides that you see in presentations here now. It's almost look, we have to have it. It's like health and safety. We just have it. Like we have safety protocols, we have
Right. Right.
rules in that, but you don't lead with your health and safety, slide here. It's just become, this is just expected here. You have good health and safety practices, kind of like you have good environmental practices here. And but okay, so now that's just kind of as set as stone. Let's talk about your business here now.
Mm. I love that your 1, 2, and 3 didn't include these things, but it doesn't mean they're not kind of underpinning. Like this is just how you operate. But there was a period of time a few years ago where that made it that ESG factor might have made it onto your top 3 list.
Yes, yes. It's interesting how things kind of change and what's important for different investors at different times. And what are the investors who are investing in the market today? What are they focused on? Goes back to, you break it down to those 13F reports. What's the Canadian, US, and international investors looking for? We can break it down between growth and value and dividend funds. And it's interesting to start to see more growth investors start to come back into the sector here. And so before it was just give me my dividend, you're starting to
Mhm.
see growth investors come back, and I think they're starting to realize, you know what, the economics here that this basin has actually does look like it could grow quite rapidly if we did start to see some more capacity open up here in this country.
Well, and some of that success, I think, thinking back to, I think even our last episode, you said, there were still some funds that were sitting on the sidelines because there was a bit of an anti-energy investment policy, but it was so clear that they missed out. I think your tobacco industry is it's a great one because I think it evokes a little bit of an emotional response in many of us, like, oh, tobacco. Okay, well, but let's look at the returns. Let's look at what we're trying to do. Is like it's an interesting balance when you play those things. And I'm thinking on our last call, you said specifically the sector outperforming really was hard for a lot of people to ignore for whatever moral, ethical, or platform they wanted to build on.
No, I think that's just it. Like, say what you will about tobacco, it will invoke different emotions with different people, but
Almost every time,
almost
polarizingly
every,
so.
but it was still one of the best performing sectors for that one decade there at the start, the early 2000s. And so it's
Mhm.
starting from a low base, and that's partially part of the performance. But I feel the same way with energy. We've rebounded here in the last couple of years, but we are still a long ways away from where historical valuations were, a decade ago here.
Let's since it's about being a better investor, it's also about talking to someone who's got a crystal ball. If you've been very optimistic on all of our calls going back to our first time we met about, hey, hold me to it. I see the sector as like this is a great opportunity. I think you said I've been in this for 20 years and this is the most optimistic I've ever been. I think I can quote you on that one.
Yep.
Where's the Jeremy confidence or optimism indicator? I'm thinking of the VIX. Where's your gauge showing right now when you look out at the next even 1 to 5 years? And I know we're picking time frames for the sake of the question.
So it's not as optimistic as it was when oil was $120 here. So
Okay,
oil's gone from 120 down to 70. Like that's a pretty big fall. So the
significant.
returns that these companies are making aren't nearly as robust as they once were.
Hmm.
But when you look at the sector today, where the valuations trade, the balance sheets that have all been repaired, and the outlook and the change in sentiment that we have for the sector here, it is a lot different than where we were pre-COVID, and it feels good here. It feels good. I think anybody who's still in oil and gas would look at this and say, "I'm pretty excited about the where the next 10 years, next 20 years are likely to be here." We have a different attitude in terms of what energy means
Hmm.
and how to make money, and it's not so much just um, let's make a great quarter and another quarter, another quarter, but it's really looking at the long-term outlook for a lot of these companies here. And let's not take excess risk. Let's not take on too much debt, and let's just run a real business here as opposed to trying to, um, get quick investors in and then out again.
Everyone I've talked to seems to be in it. Like there's a different mindset. It's a different game that's being played. And I guess like anything, industries and sectors mature and they evolve. And it's not looking at it as good and bad. It is part of the journey. And the industries that don't evolve tend to go away. Mhm.
Exactly, and I think that's just the amount of new technology that these companies are employing. So
Mhm.
even at $70, it's a lot lower than where we were before. But with the weaker Canadian dollar, the decline in what our overall take home for a lot of these companies hasn't declined nearly as much as what we've seen in the U.S. Now
Right.
we'll see what
Yeah.
happens with tariffs.
Yep.
Um, but 10% versus 25% is not nearly as bad. And
Yeah.
if it's even ultimately resolved here, it's looking favorable here in terms of what the ultimate, still the revenue that these companies are going to be making here.
Hmm. If you see the U.S. kind of coming online with the kind of drill baby drill commentary, but different reserves, obviously they have access to similar technology. Does that fundamentally change the how the world looks at oil with the U.S. producing maybe more, or do those fundamentals still just kind of play out over time?
So it's interesting. So the Dallas Fed does a survey every year with all the U.S. operators, and every
Mhm.
year, every quarter, we'll get the next update here in the next month here or so. But they ask a question in your two top plays. What price do you need to justify drilling a new well here? What's your break-even price to justify drilling that new well? And the average is around $65 WTI here.
Okay.
So we're bouncing around that here in the forward strip, right around that price. Like you're at the point here where you want to drill, baby, drill. Um, you may want to do that, but the economics don't justify that, especially with so many of these companies implementing higher dividend policies, a debt repayment strategy, buyback strategy. That's what generally investors want. And if you're at the break even price, it's going to be hard to grow. And
Mhm.
that's why we're, seeing growth in the U.S. really start to table off, even without all the change in environmental policies and things that Trump has brought here. So it's a bit of a um, the growth that we're expecting to see in the U.S. is not likely good to happen because of where the current price is here today. So that's the dichotomy that's interesting that's coming out of the U.S. here today.
Well, and I recommend people if they're curious about what you just said. I was your oil strip price, a little graphic that you have on your, I think you posted on your LinkedIn 5 days ago. It says, you've got some great little animations and like quick hit. Back to your point, you're practicing what you preach, Jeremy. And it was one of the graphics I looked at this morning before even jumping on this call. So I encourage people to go hit up your Jerry McCrea CFA and check you out on LinkedIn. You've got a lot of great information. That was one of the ones that I watched and kind of got my head wrapped around. So thanks for bringing that up. Mhm.
It's an interesting just dynamic here going on with what we're seeing in the U.S. versus up here in Canada, and just with Canada over the last, I'm going back 20 years, just the amount of regulation and trying to grow the oil industry here in Canada versus what they were able to grow in the US is completely different. And it
Mhm.
seems like we're a little bit more in a sunset phase here in the US as opposed to, I want to say, fourth or fifth inning here still in Canada. So that's where you're starting to see some capital and more US investors start to ask about Canada, at least on phone calls that we've been having with our clients.
Well, those are the leading indicators that show what people are interested in. And I have to appreciate you're listening to our past episodes. That's been a pretty consistent theme of what you've said, and certainly what I've seen after chatting with you and then kind of watching in terms of where the US is in their cycle. And once you get past the initial bluster of whatever headline you happen to listen to and you get a little bit deeper, it tends to tell a bit of a different story sometimes. Mhm.
And I think just near term right now, as we go into the next couple of weeks heading into tariffs, that is what's holding back a lot of these Canadian stocks here right now is what
Mhm.
headline am I going to wake up to next year? I just
Yeah.
there's too many unknown risks between, the Trump and the Middle East and everything that's going on here with the commodity because it's not so much what politics dictate to related to the oil and tariffs, but if there's new tariffs on China and then China says, we could go into a slowdown here, it's a reverberating effect that ultimately is still going to impact the commodity. And so this is the risk. And we got a Canadian election coming up. What are the new,
There's a million
like,
variables, right? Yeah.
so there's more headline risk now than I would say at any point in the last while. And so that's what's just keeping me a little bit trepid because investors know those same headlines or risks is there as well too, and as a result, no one wants to buy in front of a headline risk. And it goes back to what's the most important thing with a portfolio manager? Job preservation, and they don't want to step in front of something only to have a headline come out and that stock be down 5% here. So it's just you've just kept the natural buying guys on the sideline here, unfortunately, right now for a bit.
Which really back to your point about how to be a better energy investor and some of the points that you brought up, the sector, there's still a need. It's not going away. We need energy. We're going to need it into the future. Really knowing where those opportunities are, the companies that have strong balance sheets that are able to use technology to be that much more effective, even in a slowdown, those are definitely still, those are clearly the companies you want to have in your portfolio.
Yep, and I think that's the best there right there.
Mm. Well, I didn't mean that to be a mic drop moment, but if we finished it on a high note, I'm going to leave it right there. Jeremy, thanks for coming on. I always appreciate your perspective. Really enjoy our conversations. We've mentioned a couple of times. I'll mention it again. LinkedIn. If you want to learn more about Jeremy McCrea, check him out on LinkedIn. If where are you? Are you on TV these days? I've seen you on TV a few times. Where are you? Where do you have anywhere live that you're speaking?
Yeah, typically, BNN is
Okay,
usually where we kind of go. It just we live in a highly regulated world here at
we do.
and in investments, and so it's a lot of compliance work to sometimes go, and so anyways, it is what it is.
I appreciate that. No one wants to make any accusations that you said this and you told me this is what was going to happen. I think
Yes.
we all know that deep down, but fundamentally, we live in a world that loves to not take personal responsibility. Those are my words, not yours. So I think invest wisely, get good information, be aware of what's going on, and that's why I love having conversations like this because it always it peels back a few pages of the book I didn't feel I had access to before.
Well, and it's the same reason why we didn't bring up any individual names here on this call here too, because
I really
the amount of
wanted to ask, but I
yeah.
knew better, so I kept my mouth shut.
It's just it is what it is. It is what it is.
A hundred
Yeah.
percent. I think most of our listeners are well informed. Jeremy, thanks for coming on. Thanks for your time, and always thanks for what you do and the information you put out in the world, man. I appreciate it.
Thanks, Tyler. Talk soon.
Cheers.